Good morning, everyone. My name is Dominic Njehia. I'll be the moderator for today's webinar. We want first of all to thank you for joining us this morning, and we want to know where you are logging in from, so that we can also acknowledge where you're coming from. I know there are people who are joining from different parts of this country, maybe from Eldoret, from Kisumu, from Nakuru, from Northlift, from Coast, from Garissa. We want to know where you are joining us from. We will be taking you through this webinar in the next 1.5 hours, and we hope it will be educative, and we hope it will give you a practical insight of how to navigate this environment. We are looking at maximizing return at this low interest environment. To kick off our conversation this morning, we want to introduce our panelists from the far end. We want to introduce Mwenda Rarama, our CIO. Mwenda has been in the industry for more than 20 years or so, and he has been an investment practitioner and a professional for almost 20 plus years. Next to me is Elizabeth Irungu, our head of business, head of asset management, and she is a charter holder, and she has been our captain for the last 4 years, and we appreciate having that time this morning. From where you're logging in, we want to thank you for taking time, and we hope this will be very educative session, and also it will add value to your investment journey. To kick off our conversation this morning, I want to ask Elizabeth to just give us an outlook of what asset management is all about, what Absa Asset Management has been for the last 4 years. We started just before COVID, after COVID, and basically we want to know what kind of a journey that has AML gone through for the last 4 years. Elizabeth.
All right, and good morning, everybody, and thank you very much for joining us this morning. I am really delighted to see all of you on board and ready to listen to us. Our work here is really well cut out. It is to empower you. It is to give you solutions that build your portfolios and build your wealth, so that you can get to the goals that you have, the desirable goals. And I know everybody's goal in life is definitely to ace the financial side of things, even as we navigate the very volatile environment that we deal with. So let me just give you a feel of Absa Asset Management, because today I'm aware that we are joined by people who have not previously interacted with Absa Asset Management Limited. We came into life in 2019, and we are wholly owned by Absa Bank PLC. So that makes us a subsidiary of the bank, 100% owned by the bank, and we are really, really proud of that association. We operate under two licenses, the Capital Markets Authority and also the Retirement Benefits Authority. Those are the two licensees that we follow. And on the ancillary, obviously, because of being a related party to the bank, we are definitely overseen. We have some reporting lines to central bank because of being related to a bank. We currently are managing in excess of 80 billion shillings in assets under management. This is quite a big milestone for us, and we are very proud of what we've been able to achieve in the last 4 years, and it is because of you, our very good customers, and we continue to soar higher and higher. And also the other thing that we are celebrating is that we're almost reaching a mark of 25,000 customers in the relationships that are operating within us. This is a team that I work with. I'm very proud to head this team, and this is not all. I'm giving you a feel of the people who are at the top of most of the departments. We've got our Chief Investment Officer, Mwenda Rarama, very experienced, over 15 years in the industry. Dominic Jihia taking care of our business development and customer experience. And then we've got Jackie, Marcy, and Daisy, the ladies who are steering matters investments, matters compliance, and matters research, which is very important in running a business. But overall, we're about 32 people who are running the entity, of course, complemented by the banking fraternity that is very close to us. What is it that we offer? What do we do when we come every day? And these 6 pillars are showing you the different solutions that we have for different customers, because as we said, we are open, our doors are open for anybody who wants to come and invest. So on the pension side, we manage occupational schemes, or what we call discretionary pension schemes, and we also manage guaranteed schemes for those schemes that are registered as such. I think what is most common to majority of the people who may be in the call is a collective investment scheme. And of course, for Kenya, this is a very topical issue, that collective investment schemes or unit trust funds have become a common solution for investing. It is important for you to note that we've got a full suite of collective investment schemes under our banner: Kenya Shilling and Dollar Money Market Fund, Fixed Income Fund, Balance Fund, Equity Fund. All of them are choices that you can make when you come on board. Now, there is a segment that we like calling wealth management, and targets people who want portfolios that are bespoke to them. And it's important to know that if you're that specific, especially the high net worth, the affluent people who can create portfolios that are specifically made for them, we do have that solution, and we can be able to buy you different asset classes across the world. Now, retirement is a must. Retirement is part of the journey of life as long as you're under the sun. So we've got solutions that not only serve the large employers, but we have solutions that we call umbrella. And umbrella here mean that there are many people coming together. So in one instance, we have individuals who are from different companies, different backgrounds, different income levels, and they are able to join an individual pension plan and enjoy the benefits that comes with saving towards your pension. And we've got also the umbrella for corporates that are coming together, especially the SMEs. With the new regulations, you need a solution that can take care of your pension contributions that now have become mandatory. Then corporate assets, basically anybody with a balance sheet, we can be able to handle your balance sheet. And coming soon, we are bringing in a special fund. So stay near us. You will be hearing more about a special fund that is in the works. How do we deliver our service? We deliver it in several steps. These are 5 steps that we have put there. We always aim for optimal returns, and please note, we do not use highest returns. We say optimal returns because for every customer who comes or portfolio that we are managing, we are looking at benchmarks, how they would have worked, and we are looking at always optimizing those returns, of course in line with any risks that we may be that emanate from an investment. Compliance is very critical for us. And we talk about compliance because Capital Markets Authority requires and looks after the customers by giving us guidelines and regulations that mandate us how to govern. So compliance is a critical piece for us, and you saw we have a full-time compliance officer. And of course, risk management is also really important. Research is the bedrock of all our investment decisions. So when you see us making any investment, we have done research, we have done our number crunching, and we are confident. While we may not have a crystal ball around what will happen in the future, we try as much as possible to use numbers to predict what is likely to be the outcomes and take the best route for our customers. And we synergize with you through value-added value-added services like this webinar is really to empower you and not to leave you behind as we work here. So our philosophy as we invest is threefold. We have value and value growth or competitive return, philosophy. Income generation is another one, and value preservation. So depending on how you have come in and what you're seeking to achieve, we will either position you in any of those three philosophies there. Let me just dwell a little bit around risk, because in investment, the one thing that we are sure is that we make returns, but behind those returns is a risk. So do not ever forget that as your investment manager, we work really hard to always manage the risk that comes embedded with the returns that we are giving you. And it's not only Absa, it's across the world. Risk is a part of the investing journey. If you don't take risk, you don't get the returns that you're looking for. So our 6 R's of managing risk means that we recognize, we record, we respond, we recover, we remediate, and we recourse on any risk that we see during the course of investing the monies that you send to us. So whether it is market risk, credit risk, global risks, or regulatory, investment risk, operational risk, and conduct risk, the truth is we are always navigating these winding roads that come as along the way of an investment manager, but it is a way we manage them. So we have risk governance, which is very elaborate, to make sure that we navigate these areas with a lot of credible information without jeopardizing your money. So we have our board, first of all, overseeing everything that we do, and of course the board and audit risk committee also works very closely to make sure that we are taking the right risks at the right levels based on the information that we have. And then of course the management, the MANCOs, investment committee, credit committee, product committee. So there's a lot that happens behind the scene when it comes to risk management. But of course you as our investor, you'll only see the return part of it, but it is good to know that behind the scenes there's quite a lot that happens in ensuring that risk is mitigated and you are protected. So what are the value-added services that we give you? We believe that our research comes in at the top, and it is our call to action that all of us who are investors or potential investors, we empower ourselves with research, because research helps you to make credible decisions that are anchored on credible information. So we are a source of your credible research and analysis. So if you see us sending you research, please read that fact sheet just so that you know how the world is panning out. Things like financial wellness, like what we are doing today, really important for us as a way of empowering you. And of course, we've got dedicated advisors and relationship managers at the branch level who you can always speak to, and they'll be able to give you more information around what is happening in the market. And then not only talking to them, but they also show you diverse investment products that you can be able to choose. The one thing that every investor is looking for is obviously to diversify. Do not put all your eggs in one basket, and even in investments, that's a critical pillar for a successful investor. So we want to welcome you at this juncture as we delve now deeper into the mechanics of investing. But I'm really, really grateful that you have joined us this morning. Thank you. Back to you, my moderator, Dominic.
Thank you very much, Elizabeth, and we appreciate. We have seen a lot of growth in that in AML, asset management. What has worked for asset management that you can mention 1 or 2 areas? And do you think it will work well for 2026?
All right. And what has worked is that majority of people and Kenyans are starting to embrace the journey of working with credible fund managers who are accessible and who have the credible profile that cements their growth and gives them the anchor to believe that the future is actually better. What is ahead of us is actually better days than the ones which are behind us. So for us, what has worked is building on strong pillars of governance, strong pillars of investment management principles that are well, tested in the 100 years that Absa has been alive. And of course, we work very closely with our customers to make sure that we are empowering them, and therefore their trust levels are not broken at any one time. Thank you very much. And we believe that that's how we are going to continue growing, even going forward, giving you more, bringing new products, and of course, exploring new opportunities that will be coming in future.
Thank you, Elizabeth. Thank you very much. Let's zoom to global perspective, and we'll come to Mwenda. Mwenda, how has the global economy performed recently, particularly in terms of interest rates, geopolitical? We have heard about tariffs. We need to hear how the global economy has performed before we come in country. Thank you, Mwenda.
Thank you very much, Dominic. And indeed, a lot has been happening globally, and we have actually seen quite a bit of turbulence. But I'll take you back to when it all began, post-COVID. We did have an inflation problem. That inflation problem took us to a level where most central banks did not have any other choice other than to increase interest rates. But when we look back and see what has actually happened in the last 2 years, 2024 and 2025, you see a lot of that has been reversing, and I'll go through that. So from a GDP point of view, we are seeing global growth at levels of 3.3 in 2024. We do expect still above 3% growth this particular year, 2026. Most of that is coming from the developing economies, but we are still seeing positive growth in the developed economies as well. About 1.6 is expected this particular year. So when you look at the developing economies, and I know you'll also talk about Kenya and where we are we at par with our peers? Are we doing better? Where exactly is our growth? But we have seen growth now picking up 4%, which is basically driven. The economies in the developing economies may not be large in size, but they are seeing a lot faster growth, given that there are couple of things are actually working for them. And I did say, when you look back at 2020, if you look at those inflation figures, we have seen a significant change post the COVID period. We did see inflation become a big challenge, topping off in 2022. What caused that was largely the issue of the supply side, because we did have challenges in movement of commodities. We also did have demand still picking up. So how do you curtail demand? You basically have to work around the interest rates and money supply. But we also had some serious structural changes that were happening at that time. But post that, we have seen most economies see inflation come much lower. We are now at levels that we were some time back, the 2018-2019 levels, and that gives room for us to start seeing growth and start seeing central banks make changes to the model that they have used for the last couple of years. So what have we seen, and what did we see in 2024 and 2025? In 2024 and 2025, we did see central banks start cutting rates, and in particular, the European Central Bank has cut rates by 1.85% since June of 2024. We do not expect rate cuts in 2026, given that they still have a challenge in Europe when it comes to inflation. It is not at the level they would expect, but definitely that rate cut should spark growth even in Europe. When you look at the UK particularly, the Bank of England has cut rates by 1.5% since August 2024. We do see them cutting further this particular year. We expect 3 rate cuts in 2026 because the inflation is much lower than what we are seeing in the rest of Europe. But the big economy, which is the US as well, what have we seen there? 1.75% starting from September of 2024. We know there is a change when it comes to the Fed chair, and we do expect that this economy and basically the US will see further rate cuts this particular year. We expect 3 rate cuts in 2026. The size may depend on what the new chair decides, but we're also very clear that the President, Trump, is actually pushing for much larger cuts in terms of the Fed rate. This cut in rates should spur further growth, should spur further momentum in terms of the growth that is expected. And where will that growth go? And what have we seen in the last years? We always say the stock market is a barometer of any economy. So that economic growth that we have seen and that cut in interest rates in the last 2 years is actually showing. And that is what we have on our screens today. So the equity markets or the shares markets across boards have actually seen growth. At the very top are emerging markets, including Kenya. And we will speak about Kenya and the performance that we saw in the stock market. But that tells you that we have significant growth across board. Globally, if you just look at the global total, it's 20% growth. That is very, very significant, given the fact that we did come from a very significant inflation and high interest rate environment. Then that recovery is significant from a global point of view. The UK also sits up there at 21%. Europe 19%, China 18%, and the US at 16%. But that tells you that there's growth, there's money to be made, and the reason we're also having this is just to educate you and guide you in this kind of environment where we are seeing better returns. Where do you put your money and where do you benefit the most? I'll leave it at that, and back to you, Dominic, from a global point of view. Thank you.
Thank you, Mwenda, on that. Given the backdrop, global backdrop, what kind of opportunity or the risk do you see an investor from Kenya can take advantage on, especially the opportunity side?
When you look at the growth that we are seeing, the biggest chunk from a GDP point of view is coming from developing countries. And when you look at the equity performance, that does reflect. 30% of that growth came from emerging markets. So yes, there is room for diversification, and we can talk about diversification and spreading across board, but we also need to focus on where the return is. The return is in emerging markets, the return is in developing countries. There's more risk. It's an issue of how you manage that risk. By the end of the day, risk is what delivers the return. What you need to do is manage the same and make sure you participate in those returns without taking more than enough risk and getting to a level where you're actually making losses. But the developing economies are still providing the highest level of returns. That is where the money is. I would advise that is what you'd be looking at. Thank you.
Thank you, Mwenda. Elizabeth, bring it back home. We want to hear how the Kenyan market has performed in terms of interest, equity market, and all what is happening in country. Elizabeth.
All right, thank you. Let's land it home. And why is it important that we always start with macros and telling you about the economy? Because we believe that if you understand how the economy is actually panning out, then you'll be able to see the opportunities that are coming out of the economy, because the economy doesn't remain static. And of course, the economy is the total of all of us. Is what each one of us does in the productivity. It's not the government alone. It's what all of us do. And so just look at Kenya's growth. I want you to focus on the bar graph that is Kenya annual GDP growth. Now, if you look from 2019, pre-COVID, and what we are projecting in 2026, we have only 1 year, 2020, where the economy actually slumped to a negative territory, and it is not unique to Kenya. That was COVID, but we bounced back. This economy bounced back so quickly. Some economies have not bounced back as fast as they would have wanted. Case in point, and maybe Mwenda would have mentioned, is China. China didn't bounce back as quickly. They used to grow at 10% levels. Today they are growing at single-digit levels, and that tells you the bounce back has not been as fast as it has been for example, a country like Kenya. So we've bounced back. The GDP growth rates are impressive. I know that at one point the country's agenda was actually to grow this GDP by 10%. That's a Vision 2030. We had a vision that we can grow at 10% annually. That would have taken us a very short time to reach the Singapore levels that we are aspiring to, but that aspiration remains. So what are we seeing in 2026 is that by all means, the estimates that are coming from global partners like the World Bank, the IMF, the CBK, and even our own modeling, we are seeing growth coming in above the 5%. So there is growth in this economy. There are sectors that are firing well. We know that there are challenges that are underlying in this economy, but nonetheless, the economy is doing fairly well, kicking in at about 5%. We think that 2025 will close at about 5%. Quarter 3 was at 4.9%, so we believe that 5 is not far-fetched, and 2026 we actually shall do much better. What will drive this growth of 5.5 in 2026? Especially lending. I am certain that you have seen your banks have notified you of lower interest rate levels for the loans, and that means that businesses can expand, individuals can actually get into their hustles and be able to borrow at favorable levels that allows them to make a return. Previously, we are coming from a very high interest rate environment, which was not conducive for businesses, and so we believe that the lower interest rate environment that we are seeing, especially in the lending market, will spur the growth in different sectors. But let me give you a feel of how the sectors have performed, and we need to watch out what is changing in our country. Now, the 6 sectors that we have zoomed in on is agriculture, manufacturing, real estate. There's also transport and storage, financial services and insurance, and of course, you've got the commodities at the end. Now, what is interesting to note is that between 2014, this is more than a 10-year span, we find that manufacturing, not manufacturing. Let me talk about the real estate, transport and storage, financial services. They have all grown, and now they are contributing more than 10% to the GDP. That means they have been expanding at a much faster rate. They were contributing less, now they are contributing at double-digit levels. That means that is where jobs have been made. That is where return on investments have been made by those who have gone into such businesses. So there has been quite success stories in those 3 segments. Now, what is disappointing, or maybe something to watch and to drill deeper, is that agriculture is becoming less relevant for our economy. It used to contribute up to the upwards of 27% in 2014. Now agriculture is only contributing about 14%. Does it mean we are producing less? Far from it. It's because the pie has grown bigger. So agriculture has been diluted significantly, and now we are seeing we are not over reliant on one sector. And so when we say that Kenya is resilient, it means that there's no one dominant sector that actually drives our GDP. We have now different sectors driving the GDP, and therefore spread across more people, but definitely a lot more can be done. The pie can be bigger, the pie can be wider, and but it is important to know that we have a diversified economy. Unlike some economies that rely on one particular sector, Kenya does not have that challenge. Now, let me take you to a slide that is very interesting. This looks like a small mountain, a Longonot type of, type of a hill there. Now, that is Kenya shilling mapped against the dollar, our main currency that we use for both exports and imports. And because we are a net importer, it's very important that we track this number and we track how the shilling performs against global currencies like the USD. So here we find that in the last 2 years, we have seen the currency quite stable. It has stabilized at one level of about 129 shillings, and that stability is first of all quite good for an economy. We celebrate this stability on 2 fronts. For the exporters, you are able to predict how much of an income you're going to make from your exports. For an importer who is maybe importing machinery or importing goods back to the country, you're also able to predict at what price you're going to buy your goods and services. That predictability is usually very important in an economy, and so we like the stability, that there is no much volatility. Prior to that, the volatility was excessive, and so even in terms of pricing goods, the models for pricing goods were really disrupted because you couldn't tell at what price are you going to get this next consignment or even the next batch of goods that you export. So quite unsettling for anybody who is an importer or even an exporter in a volatile environment. Right now, we are in a more very stable environment, and we believe that the currency will be able to hold that stability to the end of these in the year that we are in, and largely supported by the fact that the government is holding a huge chunk of reserves. And for the first time, I think they have hit almost 6 months of reserves import cover, which is quite commendable for a government that was struggling with import covers which were below 3 months of import. So that's a good signal right there. Then we've got the inflation number. This is where the departure comes. Kenyans have a way of saying this inflation number is really not speaking the language that we are feeling in the pocket. But inflation is a point-to-point sort of marker of how prices of goods and services have shifted. And for these years, so we are going to be marking the movement of prices between 2025 and 2026. So if you were buying goods last year at 100 shillings, have they moved to 101? Have they moved to 90 shillings? Or have they moved? Have they remain flat. So in the current environment, we are seeing inflation staying at about 4.4% as at last month, which is within the target range that central bank targets. So we like inflation because inflation is what rewards investors. However, you don't want hyperinflation. For example, in the period 2022-2023, when inflation was tracking towards a double digit, that was really, really scary for anybody who is making any production, because it becomes impossible for consumers to maintain the growth of costs against the levels of income that they were getting. So at this point, we are saying inflation is stable. Food inflation is our biggest concern. We see ourselves at a stable place, obviously noting that there is drought in certain counties that are affected, but government is doing everything to make sure that they protect food price movements so that there is no spike in the food prices. So that's the only risk, that the downside risk that we are seeing in inflation in 2026, but not large enough to warrant a big concern or worry in the economy. I slide on to interest rates, and this is where we meet majority of our customers, whether it is on the lending side or you are in the investment side, you are on the interest rate corridor. So these interest rates here, they're for investments, they are not lending. So stay with me here on treasury bills and how they have moved. Another big mountain that seems to have sustained for a very long time, and we are tracking backwards so that we can see where we are coming from and where we are going. So for a long, for an extended period of time, we had a high interest rate environment where treasury bills were trading in double digits. That is now behind us, and we've been trading below the 10% mark even for the 1-year T-bill rate. So rates have continued to trend downward. Why are they continuing to go down? Where are rates going down? Rates are going down because, one, in the years preceding 2025, lending had really gone down, and banks were not lending. And that doesn't mean banks were not lending because they don't want, but the people who borrow were not borrowing because of the high interest rate environment. It is harder for businesses to borrow when interest rates are 20 plus, or even individual households, they couldn't take those loans. So because of that period where loans were not, banks were not giving huge loans, then we saw a buildup of liquidity, huge buildup of liquidity, and that's the liquidity that is now still in the market and chasing assets, so that as we deploy to lending, we're also deploying it to the assets that can give them a return. So with that huge liquidity where majority of us are holding cash, and I know you may argue, I don't have the cash, the system has cash, we find ourselves in a situation where now the rates remain fairly low at single digit levels, and this may be sustained until pre-election period. So we are likely to continue. And as late as this week, we saw central bank cutting rates again, meaning that they are, signaling to the market that interest rates need to continue to go down. That should also translate to the lending rates that you're getting when it comes to borrowing, and it is good for the economy when rates are low. Of course, for investors, it feels like this is not fair, having come from 16%, why are we getting lower? But ultimately, what governments want is to achieve full employment levels, and you can only achieve full employment levels in an economy if there's lending happening in the economy, and lending only thrives in low interest rate environment, and that is what globally all central banks are doing, trying to spur the economies to full steam. Hi, okay, let me take you to equities. This is an interesting slide. This is an interesting slide because we look back, how many years? 7 years back, how the equities market have performed using one index we call the Nairobi All Share Index. These are all the stocks that are listed in the Nairobi Stock Exchange. How have they performed? How have these stocks performed? So you find that 4 out of the 7 years, the stock market actually gave you positive returns. This is besides the dividends that were paid. So this is just price movement. We do not have the dividend yield. So if you add dividend yields, you actually would get better returns from all this because all the dividend yields were actually positive. Now, the markets are movements have been up and down, but largely tells you that the stock market is a long-term play. You don't time the market. It is a time in the market that matters most when you're coming to invest in the exchange. Case in point, look at the last 2 years. Just 2 years alone, over 70%, 75% return in 2024, 2025, if you had bought all the stocks in this in the stock market. Of course, when you get to selective portfolios, you find that return differs, but it is largely in that range and would be outperforming. So the stock market is actually predicting that the economy is going to perform much better as interest rates come down. Thank you very much. Back to you, Chair.
Thank you very much, Elizabeth, for taking us home. From our investors, that is a very good outlook and a very positive outlook. But everyone is asking maybe, what is it for a mwananchi in that kind of economy?
Right. And all of us are in this economy and we are here to multiply our wealth. So this economy is firing at different levels for different sectors. So it's very important that if you come into the capital markets, you also look at the different segments or sectors that are doing well. So even as we are investing, for example, in the equities market, we are selecting our equities based on the sectors that are firing in the right way. So you're also avoiding the areas that are actually hurting, because there are areas that are actually hurting. Case in point, we have seen manufacturing struggling quite a bit and even declining, which is very unfortunate because this economy aspires to be a first world. So a first world without manufacturing is a bit scary. So we are watching on the government what the incentives they are going to give, especially manufacturing, to unlock the potential that is there. Areas that we are very keen and looking at is especially things to do with resources. Now we have a whole mining sector. Resources will become a very critical piece, and globally it is a topical area that resources are becoming an important part of GDP growth, and Africa is indeed expected to gain quite a bit when it comes to the resources aspect. So if you're investing and looking for returns besides the capital markets, you need to look at every sector. The opportunities are there, including even real estate. There are still opportunities in the real estate. I know there's a lot of talk about affordable housing. What I would say as a bank affiliated entity is that the affordable housing is actually quite affordable, and one should consider taking a loan now that interest rates are lower and getting yourself an affordable home. Thanks.
Thank you, Elizabeth. Mwenda, which sector of the economy do you think is primed to do very well in 2026, and what kind of consideration should an investor be looking for? Thanks.
Thank you, Dominic. And what we have seen over the last 2 years, and I will particularly speak about the sector that I think has actually done very well, is the financial services sector. One of the biggest beneficiaries of a lower interest rate environment will always be in the financial services sector. Why? Because they are at the forefront of ensuring that money is supplied back into the economy. During periods of high interest rates and during periods of high inflation, all you're trying to do is reduce the demand, reduce consumption as much as possible, so you can take away the pressure on prices and the growth that you'd actually be seeing in terms of prices. So that did happen. And if you look at what we are now seeing, that diversification is actually very good from an economic point of view. A 10% contribution from the financial and insurance sector. But the biggest beneficiary, once we have lower interest rates, Dominic, is going to be the financial services sector. We should see a lot more lending coming out of banks, a lot more looking for insurance products, growth products, asset products that would actually enable you to secure what you have, even as you chase more out there. And money money is not a bad thing. Debt is actually a very good thing. The issue is, where are you investing? So during periods when there's no demand, there's little consumption, then you really can't invest, just as Elizabeth put it. If you are going to invest into a business and there are no buyers from that business, it's a challenge. But when you have consumption picking up, when people are able to get personal loans and are basically able to purchase items, then that's the right time to invest in a business. That's the right time to take a low interest rate facility, investing in that business and have it grow. That's the time when you want to take a facility for yourself and make sure that you actually do invest it in a way that you can make some money out of it. So the financial services will be the biggest beneficiary, and I do believe that we are going to see a lot of growth coming into that sector. Thank you.
Thank you, Mwenda. We take another gear. We know there is always risk in this market, and basically, when you look at correlation between risk and return, an investor need to consider what kind of consideration should an investor be taking to consider the risk and return. Elizabeth.
All right. And I have a slide that is giving you a feel of the matrix between risk and return. And in investments, you've got to have this in mind. The higher the risk, the higher the return. So those two go hand in hand. They mirror one. They really can never be separated. So in this spectrum here, we try to map different asset classes to how the returns would look like. So at the very bottom, you have your cash and treasury bills. Those will be your lowest risk type of investments. And they are suitable for certain demographics or agendas that you may have as an objective for you as an investor. So that's the lowest spectrum of risk that you can get. And you can add their money market fund. And they've got to be pure money market fund, because it's one thing to be told it's a money market fund. It is another thing to look deeply and see how the fund is invested and identify that indeed this one, while it is being branded as a money market fund, it is holding more bonds than even a bond fund. So be careful what the risk has been put in money market fund. But we would add, between cash and treasury bills, would have also money market funds there. And those ones are really low. They are more for capital protection. They are projected more for anybody who is looking to invest short term and looking to avoid losses in their portfolio. Now, when you move the spectrum a little higher, the next best kind of investment, and in Kenya this is unique because bonds, whether treasury, corporate bonds, they are earning you higher than almost like equities, because they're earning you the 13%. When you buy a bond which is maybe 15 years or 20 years, you can actually get 13%, which is almost an equity return. When you look at the developed markets, even a 10-year bond will not give you more than 5%, so which is quite characteristic of developed market. But in our markets, your bonds are earning you double-digit returns. Even in the current environment, they would come in as the next best if you're transitioning along the risk profile. If you know your risk is very low, you want now to move a little higher on risk, you should be moving more towards bonds. And again, in that segment, we'll tell you there is a fixed income fund, because it's not a must you buy bonds by yourself. Your manager can be able to buy you a fixed income fund and give you the same exposure in a portfolio instead of in a singular bond. But we have both available. Then you have the high yield bonds. These are issued by more risky corporates, and would say, for example, we saw Safaricom coming in the market. We can't quite put Safaricom as a high risk investment company. So it wouldn't be in the high yield. Safaricom would be between a treasury and the high yield. And so you saw them coming in at a fairly lower rate and almost borrowing at the government, same level as the government was borrowing, or even EABL and the like. So you find there's that element of looking at the risk, but there are other entities who may come to the market. We perceive them with a little more credit risk, and therefore they should reward you a little higher than where the government is rewarding you. Then up above the spectrum, you'll have your property. I know Kenyans, we love our property. That's why people say, land never depreciates. Land always does magic, but it is the patience in the land. When you bought land in the 90s or in the 2000s or in the mid 2000s, you definitely are seeing a return there, but more likely that it is more illiquid. You can't be able to liquidate it as quickly as you want, but the returns will actually be handsome and you will actually enjoy. So that's for money that is patient. Is not for your hot money that needs to go towards maybe school fees and things like building a home and things like that. Then further up you have your listed equities, and listed equities, why we say they have a higher return and higher risk is because prices move up and down quite rapidly. Case in point, in Kenya, the exchange allows a stock price to move plus 10%, minus 10% in a day. So if you have 3 days of minus 10, you have already lost minus 30%. That's ridiculously high, and that is what you need to be aware as you buy equities. Whether it's in the if you go to developed markets, they don't have caps. Kenya has a cap, minus 10, minus and plus 10. In the developed market, a stock can actually go down minus 30 in a day. So they don't have those barriers. For Kenya, we do have those barriers because we are still an emerging market. But when you go to developed markets, you are exposed completely. What investors want to pay for is what they take home, whether it is a plus, so you can go up and you can go down. And that's why you find things like shares. We have Black Fridays or Black Tuesdays, which have happened and have left a big dent in people's portfolios. Then at the very, very top, our selection there is alternative assets, commodities, and crypto. Those who haven't had crypto, now that also forex, because those ones now they move directionary in a very, very volatile manner. So you need to be aware as you get into those investments. You definitely are exposing yourself to higher probabilities of making high profits, but also higher probabilities for palpitations when those returns come down and the rates or the yields come tumbling down. So that's a kind of spectrum that you need to always think about. So try to map your portfolio against this kind of spectrum and ask, what level of risk are we talking about? And it's measurable. We normally use standard deviations to measure the risk and other metrics like to give us a feel of where the risk is at. But you can always engage us and we'll be able to give you a feel of what kind of risks are we seeing, and even historically or even emerging in the current environment. Thank you.
Thank you, Elizabeth. Thank you very much for that. Mwenda, let's go practical. We want to discuss about portfolio creation. We have various cluster of population, and we look here, basically looking at the age bracket. We want to hear how practical 23 years old to maybe 35 years, how he can be able to build his portfolio, considering what is happening in the environment. Mwenda.
Thank you, Dominic. That's actually something that we must get practical. Yes, we talk about GDP, we talk about a lower interest rate environment, but what do you actually want to do? What kind of assets do you want to get into? What do you actually buy? So for a 23-year-old to a 35-year-old, you've probably just started off on your career. You're starting off on your business. You've come from school, you have now gotten back into the active economy. You now do need to make money. The one thing that you have as an advantage on your end is time. You have time as a big advantage to you. You can make an investment and wait out 20 years. You can make an investment, wait out 30 years. Warren Buffett says the one thing that worked for him and the biggest advantage he had and what grew him into what he was time. He started investing at the age of 17. That time is what has borne fruit to making him who he is today as one of the richest men in the world. So what does that mean? Because you also have time, it means you can take more risk. You do not have the same moving parts. You do not have the same challenges someone else who is a bit older may have. That time gives you a big advantage, which means when you look at the risk spectrum, then you can sit much higher on the risk spectrum. the biggest, when you look at the available alternatives in terms of investments that you're looking at, then you would want to have a big chunk driven by growth. Growth would come from the high risk assets. That would be from your alternatives and from your equities. With equities in Kenya, I would say, given that we have seen the developing economies doing much better, and Kenya, of course, doing a lot better than the developing economies. We did see 30% from the emerging markets. That tells you there are quite a number of growth institutions that we actually have in this country. If you look at the banking sector, if you look at Safaricom, if you look at the likes of EABL, the growth that has happened over the last 20 years has been phenomenal in terms of growth. And you want to be a participant in that growth. You want to make sure that even as you spend, even as your share of wallet goes to banks, your share of wallet goes to Safaricom, your share of wallet goes to EABL, be a participant in the money that they're actually making. And the only way you participate is by buying their shares. Go into equities. More than 50% of your portfolio should actually be sitting in equities. Make sure you're a participant in the production that is actually happening in the economy, because that is reflected in the stock market. The other option is alternatives. They sit much higher in terms of risk. You do have your cryptos, you do have your commodities, you do have your hedge funds, because we do have hedge funds available as well. If you want to sit into the alternatives where you know the risk is much higher, which means you can lose the capital, but you can also make quite a handsome return out of it, then you'd want to make sure that you're also participating in that. Most of that might be things that may not have clarity, may not be 100% confirmed, may have their own challenges and risks that are sitting there. But when they do make money, you do make handsome money. So of course you don't want all your money in that segment, but you want to make sure that you participate, because these are the things that lead into the kind of growth that you see, that we also see, including the AI and the other items that you'll be looking at. So any alternatives, anything that is emerging, it's good to make sure that you evaluate the same, knowing that the risk is very high, but participate in that. The other thing that you want to do is start creating avenues for fixed income, because the beauty with fixed income is that it allows you to increase your investment. When you have income coming in, you can reinvest it, because reinvestment, we say it's one of the wonders of the world. That reinvestment makes a big difference, but you can only reinvest if there's income to be reinvested. So you need to create avenues for income, because alternatives and shares do not have fixed income coming into them. What you have is a dividend that may or may not come. You have an institution that may or may not do very well. So you do not have an avenue which you know there is income coming in that I can actually throw into equities, I can throw into alternatives, I can actually grow the portfolio in terms of size. So bonds provide you that. They provide you a fixed income. You know, if you have given them an institution, or you've given the government money for the next 20 years, you know there's a 12% coming in. Every 6 months, there's money coming in. And when that money comes in, you can reinvest it and you can grow your portfolio as you grow. But then one of the things that you must be cognizant of is that when you are young, a lot of things can throw you off balance. And that is where the cash comes in. It's important for you to have an emergency fund. I know when you are young, it's difficult to fathom the fact that you can actually have an emergency. But then there are a lot of moving parts in your life. You can lose your job. Your business may do well in 2 months, or may have 3 months where it's not doing well and you have challenges in terms of revenue. It's important to make sure that you're not going to start selling your long-term assets, which is basically your shares. You're going to start selling your alternatives. You're going to start selling your bonds, because most of these assets are long-term. So you need to make sure you have a fund where, in case you have instability on your income, your day-to-day living, you have instability in your business, you have a pool where you can get money out, stabilize yourself and rebuild it. Because the same business, the same job will also give you income. Your ability to generate income is quite high. So when that income comes in, save it, invest it, invest it, invest it. That is the time to actually start and build a very good portfolio that will sustain you for the next years and will grow your income ability even as you go into your midlife. Thank you very much. Back to you, Dominic.
Thank you, Mwenda. Elizabeth, we have another cluster between 35 and maybe 45. These are mid-careers. They are earning a bit more, and they also like to build a portfolio. What kind of consideration should this cluster consider? Thanks.
All right. So this is a person, and I said this is a space where responsibilities are heavy on your shoulders. You now have a family, most likely, because at this stage you have established yourself. You have a career that is progressing fairly well, or even a business that is thriving, or at least you are making more income than when you are a little younger. So responsibilities are many. So several things are happening even before we go to the portfolio. You need security. You need to secure that career by ensuring that you invest in yourself. You invest in yourself so that you can become very good at what you do. And therefore, if it is a business, you are expanding. If it is a career, you are rising upwardly, and therefore you're making more money. Now, the responsibilities that are coming, you also need to anchor them against the risks that may come. For example, family. If you're starting off with a family, you need to think insurance for your children. You need to think insurance for your children, especially on education, because day in, day out, education cost is becoming a big chunk of cost for anybody who is in Kenya. Look at how much we are paying for primary school. Look at how university education is becoming expensive. Even when it is paid by government, we are still contributing much more. So these are things that need to be at the back of your mind, and you need to start planning for them as early as possible. The other big part of your agenda will obviously be to own a home, to create a suitable home for your family. 70% of Kenyans remain as tenants, but it's a desire of majority of us to get out of tenancy and be homeowners. So that's another pillar that you need to look at. So what kind of portfolio would you be building, even as you look after all these other responsibilities that are on your head as a middle-aged person? Now, this is a portfolio that would allow you to be as diversified as possible, because you're looking for growth, but at the same time, you're also looking for cash flows, because you need maybe cash flows to service the insurance premiums that are coming. You need cash flows to put into the deposits for your mortgage and things like that, or even the buildings that you'll be making. So this portfolio is quite diversified. So you have 40%, at least 40% in bonds. This is cash generative income. So this is cash generative and allows you to do the many things and to achieve the many goals that you have and responsibilities in your budget, because your budget has quite a load. Not even to mention that you have black tax here, because here, if you're in Nairobi, the Nairobi person has to take care of the people in the villages. So quite a bit of work there. Then you have equities on one side. Equities are your growth fuel. The growth fuel, where we are saying you need to be in an equity space where you're seeing shares moving from this price to another price. For example, if you've seen even like Safaricom from last year, but 2024, I think Safaricom went down all the way to 14 shillings. Today we are talking about 34 shillings. That's called patience. That's growth. You cannot get that in a dividend. You cannot get that in a bond, even if you do the math. So your equities give you the required propel towards growth of your portfolio. Then the alternatives are very important. Is your land there? Of course, you've got your plots in there. You've got your high income or high yield type of portfolios, which are special funds most of the time. But you can see we do not recommend a large portion of your money to go to those alternatives at this stage, because you need to be aware that you're approaching a very unique stage in the next 5 years or so. So you need to be very calculated when you're going to the alternative space. Then cash is your king. You've got emergencies. You have your cars that need to continue being serviced. You've got things that just happen and we did not expect them. And so emergency has to be taken care of by everybody. Whatever the stage you are at, your emergencies need to be always planned around if it is possible, and it is the first portfolio you build even before you go to the riskier part of things. So that's how I would recommend for a young middle-aged person. And I'll want to put my last point here. For all of us who are middle-aged, that I've just given out my age right there. Now, please, let's look at how much we have in plots, because you could be having 90% in plots, because we were brought up in a stage where nobody introduced us to these other type of asset classes. So somewhat we ended up with quite a heavy portfolio in alternative assets. Thanks.
Thank you, Elizabeth, for that. Mwenda, we have this also a cluster of people who are approaching retirement, or already have retired. What kind of product or risk consideration should they make when they are building their portfolio?
Thank you, Dominic. And I'll pick it up from where Elizabeth left. Elizabeth said the challenge with the middle age today is that you may have 90% of your assets sitting in alternatives, and largely property and plots. The challenge with it is that when you get into retirement, and I'll take you back to COVID. During the COVID periods, we did realize that cash was extremely important. You did need to make sure that you had cash. You could not pay your hospital bills with your plot. You could not sell your plot. There was a challenge in terms of liquidity. So we need to start shifting towards a lot more in terms of income generated. So this is a period within which you start preparing for your retirement. This is a period within which you start transitioning to what would be standard. So you've had a life, an active life. You've had a business you've been running for 25 years. You've had a job for the last 25 years. Your income generation has come from your salary, has come from your business. And that has enabled you to create the other assets that you're investing. But as that wins away, then the other assets that you have, those other assets become extremely important, because when the salary is not coming anymore, that means the expenses are gone. When the business is not, you have sold the business because it has grown to a certain level and has grown beyond, you can't manage it any further. You've gotten another investor who is probably more able, and you've sold that business and it's still going through that growth. Then you're winning away from that and going into retirement. What does that mean for you? What does that mean from a financial point of view? Your financial portfolio now becomes extremely important, because that is what you live off. So how do you transition that? You need to start liquidating some of the assets. You need to start selling your shares. You need to start selling your alternatives and reducing that portion, and increasingly taking things that will give you a lot more in terms of income, and specifically fixed income. So from the alternatives, if you have plots of land, then you need to start selling a couple of them. And if you still, of course, will still have a portion in alternatives, then what you want to do is start converting the plots into rental income driven kind of ventures that will actually give you consistent income that will replace the income that will be disappearing from your salary or from your business. The other thing that you need to do as well is start moving away from the growth, because you have gone through the growth. You have had your 14 shillings Safaricom, it has gone with you to 30, 35, and you are happy. You have made a lot of money into it. You want to start securing that money and getting out of an active kind of scenario and moving towards somewhere where you can actually have reliable income that you can live off, reliable income that you can actually live. And you want to also start growing the size of your cash pool, because cash is king. At the end of the day, we usually say, yes, you have medical insurance. And when you talk to the doctors, they will tell you, yes, you have medical insurance. And I did get this from a doctor. But cash is your actual insurance, given the kind of scenario that we are in this country. So you want to make sure that you actually do have a pool of cash that you can easily access to take care of any emergencies that will come your way. Because at that time, your employee is not there to support you. Your business is not there to support you. So what you really need is make sure that you have a proper pool of cash. So pre-retirement means you need to start transitioning and making sure that you're also not going to be very active. If it's a business that you are in, you may not have the physical energy to keep doing as much as you are doing. So the revenue generation of that business may be impacted. You may not be able to give your 100% to it. So you want to move towards bonds. And the beauty with bonds is that they are not just long-term, but they give you fixed income. That income is consistent, every so often, and we can structure bonds for you and ensure that every single month there is income that is actually coming into your pocket. You can also go into a fund. If you buy the fixed income fund, the fixed income fund is 70% treasury bonds. That ensures that there's income coming in at any one time, and that income will sustain you and replace that income that will be lost even as you go into retirement. So yes, transition is difficult, but you need to really, really reorganize your portfolio and prepare for the rest of your life. I usually say you can go all the way to 50 having worked, and the Lord blesses you with another 50 years. during those extra 50 years that the Lord has given you, you must live off your financial portfolio. So it's important to make sure that you transition towards your financial portfolio to ensure that that financial portfolio supports you. And that's the reason why we are here. Thank you, Dominic.
Thank you, Mwenda. Thank you very much. Elizabeth, we have business people. These are, they invest their capital to generate return and create jobs. What strategy can a business owner adopt to also enjoy the passive investment returns that we are talking about today?
Okay. So for the business person, I think the first advice that I would give is, whether you're a small business, micro, small, medium, I know we are segmented in very many things. Like even now, Nyota has come. Those are micro businesses. I think the one thing that I would first recommend is separate the money that is for the business and the businessman, the entrepreneur. The entrepreneur's money is not the same as the business money. And I know that you do a lot. You're almost assimilated to your business. But over time, you need to separate the two and know this is capital and this is a return for me as a business owner. Now, I'm dealing here with the capital that belongs to the business, and for every business, small, medium, large, one of the pillars of securing and ensuring that the business overcomes the challenges that may come, the kind of environment we are seeing, which is so volatile, the VUCA environment, volatile, unpredictable, complex, and ambiguous. I think that environment needs to be dealt with at the balance sheet, not at the cash flow, because you're working very hard to produce your goods and push them and commercialize them to the market. But the balance sheet assets need to be your anchor, fallback plan when things don't pan out as intended. So in that balance sheet, you need to invest with wisdom. Your business idea is already your risky idea where you're looking for high ROI because you're going out producing a good or a service and offering it to the market. So the balance sheet cannot also pursue the same risk as the entrepreneur. So the balance sheet needs to be solidified and held in assets that are secure. So your assets that are secure, first of all, you need cash flows for your day-to-day running. Optimize them by having them maybe even in a money market fund, not in a current, not basically lying idle somewhere. So you optimize that either in money markets, in treasury bills and things like that for your cash flow needs. And you can be able to plan around your cash flows, however small or big they are. And then for anything that is more long-term, medium to long-term, all of it called retained earnings, push them more to secure investment grade bonds and government bonds where you'll be able to earn more cash flows from it, and it can go into your expansion, and it can also support you when it comes to facilities that you're picking in the bank. Because what we have seen mostly is that SMEs are picking facilities and they are the security for their facilities. You can be able to build a portfolio that becomes the security, and you stop attaching your personal assets like your home. You be attaching assets that belong to the business, and therefore unlock the next phase of growth and secure yourself as the entrepreneur. So quite a bit of metrics that need to be done there, balancing that need to be done. And of course, it's a journey that you do day by day, and you grow towards that resilience, just like the large corporates do. Thanks.
Thank you, Elizabeth, for that. We'll go to the audience, to our investors. We want to pick some questions. And I'll start with Mwenda. There's a customer, a client who is asking, if I want to invest on KPC IPO, what are the requirements and who can I guide me?
Thank you, Dominic. The IPO is a securities exchange transaction. Ideally, the advisors will be the stock brokers. They will be the ones to guide you. and help you. But we will definitely be looking at KPC from a fund level. We do have an equity fund, and see whether it's a worth investment from the equity fund. But our advice would be visit a stockbroker. We do have our branches as well that can be able to support you as part of the Absa fraternity. If you are looking for facilities towards buying the IPO, we do have loans available that can be able to support you through the same. But the transaction ideally would be through stockbroker. Absa does have ways of facilitating the same, and the branches can guide you on that. But the best advice and the best guidance from a participating point of view would be from the stockbrokers. Thank you.
A question from Stephen, and this goes to Elizabeth. A decline in agriculture contribution to GDP at 15% means that 70% of Kenya's population are getting poorer. The speaker need to highlight what need to be done to improve agriculture performance.
Wow, that sounds like presidential advice that is being sought. But I'll try. I'll attempt. So, agriculture contribution for agriculture has come down, Steve, and we believe that the contribution for agriculture has not come down because more people are getting poorer. It's because the economy is transforming and getting more diversified. So we are less reliant on one economy, which was primary agricultural activities. So bear that in mind, because the pie has become wider. If you look at the GDP per capita, that is the production per person in the economy, we are able to produce much higher than we were producing when agriculture was 30%. So it's because of the economy growing growing faster in other sectors that we have diluted agriculture. But what can be done, because it is still the one sector that supports majority of Kenyans. So some of the things that need to be done is structural adjustments that the government already has started. Case in point, the subsidies that the government is giving farmers are very important for unlocking their value so that their productivity can go up. When you look at the production per acre for different crops, you find that Kenya is producing much less per acreage, and therefore we need to improve the productivity. And some of the measures and actions that have been taken by the government are actually positive. And I've talked about the subsidy on fertilizer, the subsidy on the kind of seeds that they are using, because using the right seeds means better production, and of course the empowerment by having the right agricultural practices being embedded among our farmers. And lastly and not least, we need to move from the aged farmer to a younger farmer who can adopt to technology, to AI, to better production practices that can improve the productivity of farming. But largely I'm saying we haven't become poorer, but we have diversified the economy so that we are producing much more, and therefore agriculture is becoming less and less of a reliant sector.
Thank you, Elizabeth. This goes to Mwenda. What is the effect of government paying bills versus interests on loans? Could paying bills attract interests?
Thank you, Dominic. And I will speak about the challenges we have had in terms of money supply and what paying bills do mean from that point of view. So in the recent past, we have seen the government basically start paying off the pending bills. But what does pending bills really do to a business? You are a supplier to the government, you have supplied a service, you have supplied goods, you have not been paid. It has a big impact on your ability to consume. When you couple that with the fact that we had a high interest rate environment, which means you also cannot get cheap facilities and cheap loans to be able to augment your consumption, that hurts you significantly because it actually does impact your working capital. And Elizabeth spoke about the SMEs and what it actually means for an SME, that you need to have cash, you need to diversify your financial portfolio as much as possible and build an ability to be able to sustain. That cash that you saw there, 50%, is basically working capital. So you have taken your working capital, you have bought something, you have delivered the same, you have not been paid. It has a big impact on you as a business from a working capital point of view. You're also not able to supply your other customers. But the biggest challenge is we also didn't have demand from your other customers. So we have seen businesses suffer significantly. From an interest bearing, and whether you can actually charge the government interest on what they haven't paid and they're paying bills. I may not comment on that, but it's just to realize that if the government has started putting in place ways of being able to pay those spending bills. Basically, it's one of the ways of getting money back into the economy. As banks are lending, these SMEs also need to be paid that money back. When that comes into your working capital, you're able to buy more goods, you're able to supply more. You also have your buyers starting to get some facilities and getting money back into their pockets through the likes of Nyota and everything else. There's ways of getting money back into people's pockets, and as that happens, then your business should recover. So the question is, even as you do business at anyone, there's risk that comes with it. Make sure that you basically can insulate yourself against that risk so that you survive difficult periods. Those businesses that have been able to survive the difficult period that you have come from, now is the time for growth. Now is the time for you to borrow. Now is the time for you to invest. Now is the time for you to be paid your pending bills where the government is able to pay. And that all comes back into your working capital. And when it comes, prepare yourself for the next one. Make sure that next time you have actually diversified your financial portfolio. You have done what Elizabeth was advising us to do, so that when that happens next time, your ways of ensuring that you can augment the income and the business can survive and wait for the next cycle, because economies are cyclical. You have a bad period and you have a good period coming. Survive the bad periods and grow during the good periods. Thank you.
Thank you, Mwenda. Elizabeth, there's a question from Peter. He's asking, what is behind the trend of a stable Kenya shillings to USD?
All right, the shilling to the USD. I think it is very intriguing to see our shilling stable for such a long time. I think we are all doomsday guys who are expecting the shilling to actually keep on sliding, and there are macros that can support a weaker shilling, but there are also macros that support a stronger shilling. But as it is right now, we are trending very, very stable at a range bound level. So what is supporting this? One is that we've got buffers. The central bank has enough buffers in terms of what they call reserves. The central bank reserves have increased significantly since 2019. I think they had really gone off at touching a low of about 3.4 months of import cover. But as we're speaking, and as I had mentioned, these reserves now are at an all-time high of almost touching 5 months of import cover. What does that mean? It means that in the event that there were global shocks, and global shocks are, for example, what we saw last week when US was almost threatening that they will do something about Iran, and ultimately what that meant is that oil prices could actually spike up, and we did see the oil prices go up to an extent. If indeed that had materialized and that's a global risk, you would find that oil prices would spike, and you can imagine that every month we are importing oil, so we would have to face a higher importation bill that government needs to foot with the reserves that we have. So if a government doesn't have reserves, it means that the importation of such goods would actually be very pricey, and it would filter in as a major risk in the inflation sector. So when we have a government that has maintained good reserves, they can be able to come in and support the currency in the event of a major shock in the economy, especially the downward, the shocks that are likely to create a weaker shilling. So they have that ability. The other thing that we note is that as an economy, and through this administration, one of the things that has been a big agenda item is export of labor. And they've exported labor, and for that reason, we continue to see remittances from diaspora growing and increasing year in, year out. So those diaspora remittances means that we have a flow, we have an export, we are exporting labor. So yes, we are not exporting a lot of goods as we would intend, but we are exporting now plus labor, and therefore the inflows in the capital account are also fairly strong. So those are the things that are supporting the currency. But what is likely to work against this currency, because there are always downside risks? What can work against us is if the economy goes back to luxury kind of importation. If you recall, some time back, imports were really growing fast, but what government did is that they introduced large taxes in the importation of goods, which are especially luxury items. Your cars, they are being considered as a part of luxury. Your furniture, we stopped, the government put huge tax margins on imported furniture. So the items they have specifically targeted to just curb on importation of unnecessary goods. I think those are the measures that are also supporting them, because then as people get to borrow more with a lower interest rate environment, likelihood is you're not going to import for consumption, you're going to import capital goods that help to produce more goods and therefore anchor the economy for better resilience. So there's a lot that happens in the currency. We only highlight part of the things that are there, but the model is complex, and right now we are seeing a favorable macroeconomics that are for a stable currency than a weaker currency going forward.
Thank you, Elizabeth. Mwenda, there is a question from Andrew. Please explain how Absa Gold ETF works.
Thank you. The Absa Gold ETF is a listed asset. It's basically just like any other share. So what you're buying is a share of whatever the gold reserve is. It's a commodity that has been taken and put into what we call an exchange traded fund, which means it's actually a fund, just like what you'd have as a unit trust. So it's a fund that specifically buys gold and has a price tagged to it, and you can go to the stock market and buy. So that gives you a lot of opportunity, and it means you can actually have smaller lot sizes. For example, when you come to a money market fund, the minimum is 1,000 shillings. It doesn't mean that when I go to a bank, the deposit will be 1,000 shillings. The bank will be looking for wholesale deposits, and that's why we basically build a fund. So the money market fund is 70% deposits. All those deposits are sitting with banks. But when you go with 1 billion, you go with 2 billion, you go with 3 billion shillings, the rate you get is very different. If you go with your 1,000 shillings, you not get the same. So what the Absa Gold ETF has done is pulled the money into a fund, gone and purchased gold, and basically tracks the gold price as is, and enables you to buy small lots of that and be a participant, just like what you'd have in a unit trust fund. So all you need to do is have a CDS account and be able to go through your broker and purchase gold directly. But you also can buy into an equity fund. Our equity fund does hold gold as part of the portfolio that it actually holds. So if you're not interested in specifically just buying the gold, then the best scenario is going to an equity fund. You may not have the time and the research and the expertise to be able to decide which particular share to buy, when to buy it, when to sell it. Come into the fund. We have analysts, we have investment managers, we have a whole investment committee that sits to make sure those decisions, and we'll ensure that we deliver the return that you're getting in the equity fund and track the stock market as has been, without subjecting you to risks. Thank you.
Thank you, Mwenda. Elizabeth, there's a question from Peter. He's asking, can you give more detail of the umbrella fund and individual pension schemes?
Okay, I like that question, because that's somebody who is alive to the fact that retirement is coming. Retirement is for all of us, whether you're called employed, blue collar, white collar, whichever collar you want to call it, you will face retirement, because retirement is about your body just saying, I can no longer take those long hours of work. I need to just be supplied with the right environment, right, lifestyle, so that I continue thriving up to, sunset years. So what is an umbrella? So I'll start by handling the one for employers, which is the Absa Umbrella Retirement Benefit Scheme. And this one is a fund that only admits employers, and specifically we are calling on SMEs. If you recall, if you've been very keen, reforms in the pension sector have been happening since 2013. And the first reform that happened was the passing of the NSSF Act of 2013 that required, or that stipulated, that Kenyans, whether in the formal sector or informal sector, shall contribute up to 6% individually for their pension, and their employer will also contribute 6%, and that was made mandatory. And it didn't take effect because COTU went to court, and other people and FKEs, they went to court to counter this regulation, but the court ruled, I think in late 2020, they ruled, and the court ruled that that regulation will go on. So the regulation came into force, and now all of us are required as a mandatory requirement that occupational schemes shall contribute 6%, 6% from the individual employee and 6% from the employer. So that's a saving towards your retirement. It is no longer a social security type of fund. It is a pension fund, because social security means that the government used to contribute towards it and would give you something. Now it is a pension scheme. So for all SMEs, what we have done is probably you have 2 employees or 3 employees, but you're required to be compliant. And when you're going for those tenders, you'll be asked for an NSSF compliance certificate. So what we have done is to help employers to come together and subscribe to this fund and make their contributions towards these mandatory regulatory requirements that have now started. This year, I think, is the 5th year of the rollout of the NSSF fund contributions. And so when you join in by just signing a deed of adherence as an employer. And what will happen is that you will stop contributing all your 100 your contributions to NSSF. You're allowed to only contribute what they call Tier 1 contributions to NSSF, and your Tier 2 contributions can come to a private pension scheme. Then that's the umbrella scheme that you come to. So that gives you transparency, gives you ability to see your fund and to follow through, because you can imagine the amount of work, administrative work, that NSSF will have when looking after in excess of 10 million individuals. And for sure, we all know how our government entities are operating. There's still a lot that needs to be done. So I'd really urge that if you are an SME, if you're a business person and you're required to comply to this rule, consider an umbrella fund. It's a one-stop shop where you only sign one document, provide us with the employees' details, and we are able to onboard you to a private scheme and therefore divert your Tier 2 contributions, which are the largest. For example, from this month, the minimum contributions that the fund will be taking is about 6,000 shillings per month, which is quite large when you look at it. And so you can be able to do that. Now, the other fund, which is also an umbrella, it's an umbrella that brings people from different sectors, from different backgrounds, and with different incomes, and allows them to save towards their retirement. So you're passionate about your retirement. You want to enjoy especially the tax benefits from contributing into a pension scheme, because there's tax benefit up to 240,000 that you contribute to a pension scheme. That goes tax free. So you can be able to join an individual pension plan and contribute towards it in your own personal amounts. You do not have to be, for example, be prescribed for 6%. You can decide, I want to be saving 10,000, 20,000 towards pension, and you'll be able to do that through an individual pension scheme. Now, the beauty about pension scheme, saving in a pension scheme, is that today, if you reach the age of 50 and you've been contributing to a pension scheme, all your benefits will be tax exempted. So it means contributions in a registered pension scheme allows you to get tax-free benefits at the end of when you turn 50 or above. So quite big incentives towards saving for retirement, whether it is in a private individual pension scheme or an occupational scheme like the one we have for the umbrella fund. So those are the two funds. There's still a lot more. We do a lot of training even for your employees, so that they can understand exactly what is happening, and so that they can be empowered to understand what are the rights. There are even things like you can accessing using your pension benefits as a form of security towards your towards maybe owning a home. There are all those facilities that are available. So more benefits are available. Speak to us, speak to our teams. We'll be able to educate you, educate your employees, and see how we can take the journey of investing towards your retirement much easier, much better, and much rewarding. Thank you.
Thank you, Elizabeth. I think for the benefit of interest of time, we take the last one from Mwenda. Does Kenya have an index fund like S&P 500 in the US that can invest in? Equities in Kenya are looking promising.
No, we do not have an index fund, but ideally what an equity fund does is it tracks something very close to the index, but it gives the advantage of having a manager who actually can pick out the better performing assets in that index, because an index fund gives you the whole index, the good performing institutions, the non-performing institutions. It gives you exposure to the full market. What an equity fund does is that you actually have selection, and that selection gives you an advantage from an earning point of view. And it also gives you insulation in case there are challenges in certain institutions. The manager should be able to catch that through their research and their focus and get out earlier instead of being in an index fund. So we do not have an index fund in Kenya, but the equity funds do provide you a solution to that and provide you an avenue, still being able to invest in the stock market without having to go directly and decide which shares am I buying per se. Thank you.
Thank you very much. Members, investors, we acknowledge we have a lot of questions, but for the interest of time, we'll reach out to you separately after this function and answer all your questions going forward. Your parting shots. Mwenda, from what you have discussed this morning, what would be your parting shot for the day?
My parting shot would be, it's important and extremely important, start building your financial assets portfolio. And as you do that, financial markets are diverse. They offer you different options at different stages of your life, at different risk appetites. Know yourself, understand yourself, and if you have any challenges from a financial wellness point of view, a financial education point of view, please get a partner, a trusted partner, one who can be able to walk this journey with you. You don't have to do it alone. Institutions are there, including ourselves, to support you in that journey. Come have a discussion with us. Let's plan the way forward together, but you must have a plan. You cannot implement unless you're prepared. That being prepared means know your risk levels, know what amount of money you're talking about, and to what extent, and how can you actually grow it faster, and where can you put it. So that knowledge is important, and once you have that, and where you're well equipped, the rest is implementation of that particular plan, because that is what will ensure that in your later years, you have something to live off, because in your later years, your financial assets will become extremely, extremely important. Thank you very much.
Thank you, Mwenda. Elizabeth, your closing remarks.
Okay, all right. So my closing remarks are one, diversify. Diversify your portfolios, because even as we looked at the different cohorts of different age groups, you find that there's no one time we recommended one particular asset class. So diversification is your friend, and you need to start it even when you have little money. You can diversify it in unit trust funds. That means you have a bit of equities. Every time you're putting your, say, 100,000 shillings, put some in your emergency, which is your money market, put some in a fixed income, put some in the equities, and of course, you can buy your land. So diversified according to your need. Now, the other thing, and it is a warning to all of us, because as Kenyans, we tend to go to the most shiny product that is being post everywhere. And I leave this with this particular picture here. Look at that. These are two giraffes which are inside a pond, telling all the others who are out, come in guys, it's not deep. That statement is factual to the giraffe, but it is not factual for the other animals, because definitely we know how high or how tall a giraffe is, and that means the waters are deep. It's the same thing with investment. So this, I draw a parallel with investment. Every investment that, or the most popular investment that you are getting out there, you need to ask yourself, is it for me? Is it deep? Am I tall enough for this investment that is being hyped and is out there and making rounds and rounds and rounds? So make sure you assess it for you and not just take the word from hearts. In investment, we call that it is a hard bias, where you follow things as a hard rather than looking at them as an individual and tailoring it for you and making sure that it meets the purposes that you have, because your objectives are very unique to each and every person. So be sure to assess yourself. That's my call to action, even before you select whatever we serve you as Absa or any other manager in this market. Thank you.
Thank you very much. We have come to a close of this session, and we want to thank the attendee for taking time to be with us this morning. It has been 1.5 hours of discussion. We have the organizer of the event, the Absa Bank and Absa Asset Management, for giving us a platform to share these insights with our customers and potential customers, to our research team who have done a lot of work to give their insight and also to prepare these materials, also to our colleagues and who have also joined from different areas. We are available to serve you from all across the country, all the branches of Absa. You can always pass by and ask for more information about this investment product, and also at our head office where the Absa Asset Management is based. So with that few remarks, we come to a close, and we thank you very much for joining us this morning. Have a wonderful day ahead.